Hello and good morning to everyone. Thanks for joining the 118th session of uh, our knowledge webinars by BBA. Today we have Mr. Manohar Mishra and he will be speaking on the topic valuation techniques for corporate restructuring. I hope all of you enjoy our BBA sessions from every second and fourth Saturday, and we hope to bring you more such sessions in the near future. I'd also invite Mr. Manohar Mishra to become a member of BBA, and I'll urge Vidya to reach out to him later on and make sure that he becomes a member so that we can continue to have our relationship in such webinars. With that, I would like to ask Mr. Ravinder
Yeah,
Chatterjee to introduce the speaker.
yeah. Welcome, Mr. Manohar Mishra ji.
Thank you,
Mr.
sir.
Manohar Mishra ji is an FCS co-founder and partner at Mishra Kumar and Associates, a peer-reviewed firm of practicing company secretaries. He is a registered valuer and also a social auditor. Currently, he serves as a secretary of the Hooghly chapter of ICSI and holds the position of chairman of the placement committee for the Hooghly chapter of India. With over 10 years of experience and strong expertise in managing corporate compliance, he provides paralegal support in corporate law, SEBI law, and RBI matters. Additionally, he offers valuation services for securities or financial assets as required under the Companies Act and IBC Code and various other regulations also. His extensive experience has honed his skills and deepened his knowledge, enabling him to effectively address complex legal and financial issues. Alongside his professional responsibilities, he is passionate about sharing his knowledge and insights. He actively participates as a speaker in various seminars, workshops, and conferences where he enjoys discussing and sharing information on corporate compliance, legal framework, and financial regulations. This engagement allows him to connect with peers, contribute to the professional community, and stay informed about the latest industry trends and developments. Excellent profile, Mr. Mishra ji. Welcome.
Yes, sir. Okay, so first of all, I would like to thank all the managing committee of BBA for inviting me, and thank you, Ravi Chandran sir, for introducing me so well. Okay, so shall I start?
Yes, sir.
Okay, so basically, I have divided this topic into three parts. First of all, we will discuss more about the process of mergers, all about the mergers. Then we will discuss about the valuation approaches, and then we will discuss some practical aspects in corporate restructuring. So the first thing is why corporate, what is the meaning of corporate restructuring? Every time we heard this word that what is corporate restructuring? Many times we heard in every single day that some companies are going for corporate restructuring. So what is the simple meaning of corporate restructuring? If we define in a simple way, it simply says it means a significant move by a company for making changes in financial, operational, legal, or ownership structure with the aim of improving its overall efficiency. That means whenever a company is doing corporate restructuring, there should be an objective, and the management should evaluate those objectives before entering into any corporate restructuring. Now the question arises, why corporate restructuring? So there are some reasons why the companies are going for corporate restructuring. Some companies are going for corporate restructuring because the company wants to increase the company's value as well as the shareholders' wealth. Some companies are doing because they want to increase their operational efficiency and the economies of scale. Some companies are doing it to reduce their debt. Say, for example, in case of a reverse merger, some companies are doing to refocus on its business activities. Some companies are doing because they want to do a regulatory changes as per maybe either by the regulatory or maybe as per their operational or any other financial reason. And some companies are doing their facilitating mergers, amalgamation, demerger, reduction of capital on the basis of their objectives. Okay, so I one thing I just want to whenever I will we will take up the questions in the last. So if you have any question, just kindly put the slide so that it will be easier for me to discuss the question answer at the end of the session. Now, the question arises ki what is the mode of corporate restructuring? If we can see that there is an internal part, someone is external part. So, if in case of internal restructuring, the company can do corporate restructuring by way of slump sale, by way of purchase and sale. And in case of external restructuring, the company can go for merger, demerger. And in case of internal restructuring, the company can do the corporate restructuring by way of capital reduction or buyback of shares. So today we are going to discuss about mergers and more about the mergers and some techniques of demerger as well. First thing that the term merger is not defined under the Companies Act. So this is one of the most important thing that whenever we are searching for that what is the merger, so this term is not defined under the Companies Act. But if we look at section 230 subsection 1, so there is a word called arrangements. It says arrangement includes reorganization of the company share capital by the consolidation of shares of different class or by the division of shares into different class or by both of those methods. That means the word merger is not defined, but the term arrangement is simply defined, and whenever the companies are going for corporate restructuring, so they refer this section accordingly, they plan their corporate restructuring. We can take a simple example. Say, for example, there is a company A Limited whose shareholder is A, and there is another company called B Limited whose shareholder is B. Now, the company A is planning to merge with company B Limited. So, post merger, company B will issue shares to the shareholders of A Limited, and accordingly B Limited will have two shareholders. We are assuming that there's a holding kind of a holding a subsidiary company. So post merger B Limited will have two shareholders, shareholders A and shareholder B. That means A Limited merged with B Limited. A Limited existence has been merged. So right now A Limited will not be exist, and all the shareholders of A Limited will be the shareholders of B Limited. Accounting Standard 14 and Ind AS 103 defines the term accounting for amalgamation. Now, if we will see section 2 subsection 1(4) that defines the term amalgamation. So it simply means amalgamation means merger of two or more companies to form a new company in such a way that all the properties of amalgamating company becomes the property of amalgamated company. That means there should not be any property left with the amalgamating company. All the properties should be transferred to the amalgamating company. Second condition is that at least 75% shareholders in value is more important, shall become the shareholders of amalgamated company. That means if there is a less than 75% members who are willing to become, or if they become shareholders of amalgamated company, then it will not be called as a amalgamation. This is a precondition that at least 75% shareholders should be the shareholders of amalgamated company. Third condition is that all the liabilities amalgamated company becomes the liability of amalgamated company. So we have to satisfy all these three conditions to complete our amalgamation as per section 2 subsection 1(5) of the Income Tax Act. Next, this is a basic concept of merger and amalgamation. Merger simply means a combination of two or more company, that is there will be either a one or more transferred company and into a one transferee company. The term mergers and amalgamation are used interchangeably. That means every time we use the word merger and amalgamation interchangeably. In case of merger, transferred company will lose its assets and will lose a separate entity. All the liabilities and assets of the transfer company are transferred to the transferee company. Transferee company in turns will issue shares to the shareholders of transferred company. In case of a transfer company, either the shareholders are willing to become the shareholder of transferee company, or if they are not willing to becomes the shareholder transferee company, so they can take some amount in consideration as a minority shareholder. So as we discussed in our second or third slide, that in case of amalgamation, all the property and liability and the assets of the amalgamated company are observed by the either by the existing company, or a company or a new company can be formed who will take over all the assets and liabilities of amalgamating company. The amalgamating company post its merger or the post its amalgamatum will be winding up. There are various kinds of mergers. Like in case, we can divide mergers into four categories. One we call horizontal merger, vertical merger, conglomerate merger, and reverse merger. So we can take that means horizontal merger simply means a company who is dealing into a direct or indirectly with each other in the same kind of business. Say, for example, Vodafone and Idea. In case of vertical merger, company operating in the same industry but a different stage of production or distribution. We can take an example of upfront color with BPL. In case of conglomerate merger, it's between unrelated business but having no competition, like ITC Hotels with ITC Limited. In case of reverse merger, that means a profit and loss making company unlisted or listed with unlisted company. You can take an example KB Mall with Ford Future Network. Now, regulatory framework. This is more important because whenever we are planning for merger, we have to look at what are the laws that are applicable in case of merger and amalgamation. So first of all, we will have to look after section 232 to 36 and read with its rule and CLT rules. In case we are going for section 232 to 32, we have to look after SEBI regulation if it's a listed company. We have to look after accounting standard and Ind AS in case Ind AS is applicable. We have to look after the Competition Act 2002. In some of the cases, the approval from CCI is not required. That we have to look that whether we need to get the approval of CCI or not. We have to look after the Income Tax Act, and last but not the least, we have to look after the Indian Stamp Act. So all these rules and regulations we have to follow whenever we are planning for merger and amalgamation. So now we will discuss section of the Companies Act. Like section 230 deals with the power to compromise or make arrangement with the creditors and members. That means it has the power to make compromise not only with the members but as well as with the creditors as well. So section 230 states whenever a compromise or arrangement is proposed between a company and its creditors or any class of them, or between a company and its member or class of, that means not only a company or creditors can go for merger or amalgamation, but a company and its member can also go for merger and amalgamation. So whenever there is an application either by the company, either by the creditors, either by the company and its members, the tribunal main application by either by the member or company or creditor, or in case a company which is going to be wanted by the liquidator, shall order a meeting of the members or class of members. The application to be NCLT shall be in form NCLT 1. The notice of admission shall be in NCLT 2 and affidavit shall be in form NCLT 6. These are the prescribed formats which is given in the NCLT rules. These were section 230 subsection 1. Now section 230 subsection 2 says whenever there is an application is made to the tribunal, then the company or the applicant shall disclose all the material facts relating to the assets of the company. If there is a reduction of capital, if any, included in the scheme of amalgamation, scheme of arrangement, that means if a company is willing to cancel their capital post merger, then that should be included in the scheme of arrangement. Any scheme of corporate restructuring shall be approved by not less than 75% of the creditors in value. That means at least 75% creditors should approve that key, or the creditors should give by way of a consent that key we have no objection for this compromise arrangement, and the creditor responsibility statement that we have to annex with our application shall be in format CAA1. Whenever we will make an application in section 230 subsection 1, we will make an application. In section 230 subsection 2, we will have to disclose to the tribunal by way of an affidavit and all. And in section 230 subsection 3, the tribunal may order for a meeting of the creditors or members. So if there is an order by the tribunal for meeting of members or creditors, so we have to give an intimation to the members and the creditors in form CAA2, and it should be advertise in a newspaper within 30 days, before 30 days from the meetings of the creditors is called, in one English newspaper and in one regional language wherein the registered office of the company is situated. And if there is a separate class of meetings, say for example there is a class A and class B, then a joint advertisement can be issued. Now, the question comes, say for example, the company has planned for merger and amalgamation, and the creators and the members is not willing to approve. So the question arises, who can object for this mergers and amalgamation? So section 234 subsection 4 says the objection can be made by a creators who is having at least 5% of total debts, and a members who is having at least 10% of total shareholding. That means a minority shareholder or a creators can object for a scheme only if they have either 5% of total debt who is outstanding, or a member who is holding at least 10% of total shareholding. So these are the person who can object. Now the question arises, whose approval is required. So whenever we are going for a merger amalgamation, approval from at least 50% of creditors by way of majority is required. By members, at least 50% majority of member is required, and at least, and in if there is any creditors, then at least 3/4 in value, whose creditor value is at least 3/4, they should at least approve the scheme. So objection can be made by 5% of 5% total debt, members who can object who is holding 10%, and approval required from member who is holding 50%, and creditors who is holding at least 3/4 in value. 230 subsection 5 says the notice of the meeting. Whenever there is a meeting called by the tribunal, so notice, so we have to issue a notice of the meeting. The notice of the meeting shall be issued in form CAA3 and shall be accompanied by a scheme of compromise or agreement. In many cases, the companies, what they do, they just send a notice without having a scheme. So the members can object that we didn't receive any scheme of arrangement. The same scheme shall also be sent to the central government, or in case of RD, like in our case, it's RD, registrar of companies and the income tax authority in all the cases. Irrespective of any fact, we have to disclose to all these three authorities: RBI, SEBI, Competition Act, and the Stock Exchange. If they are applicable, then we have to give a notice of meeting to all these regulatory body. And if the company is regulated by any other regulatory body, then we have to issue notice to that regulatory sector as well. We have already discussed that key, if we want to get the scheme approved, then we have to get the approval of members and creditors. If 75% member or creditor approves any scheme, then it should be binding on a company, and all the members and creditors will have to accept it. And say for example, in case of a binding up, it has been either, if it is approved, then it shall be binding on the liquidator as well. The tribunal, say for example, in many cases, it's like, say for example, in a closely held company, it's become very difficulty for calling members, because they are the only the shareholders in a company, so they no sense of calling meeting. So if we want to dispense the meeting of members and creditors, then we have to get the approval of members or creditor at least 90% in value. So if the creditors and the members approves by way of a consent or by way of affidavit that we have no objection for this merger and amalgamation, then we can dispense with the calling of members and creditors. In many scheme, you will see that there is a plan for buyback, corporate capital reduction, name change, demerger. So whenever there is a buyback in a scheme, so it can only be sanctioned by the tribunal if it satisfies all the conditions of section 68. Now, say for example, the company and the creators and the members has accepted the uh, merger and amalgamation, but there is a minority shareholder who is not agreed for this merger and amalgamation. So they can make an application to the NCLT that we are not in favor of this corporate restructuring. And accordingly, NCLT will heard its application. And accordingly, after having all the requisite information, and if the NCLT feels that merger and amalgamation not in public interest or not in the minority interest, accordingly NCLT will pass the order. So this was the section 230. Section 230 section 230 simply this: what is the order of, what is the power of NCLT, and what is the process for calling meetings, and who can object for the scheme, what is the manner in which the approval is required. Now section 231. Say for example, if NCLT pass an order under section 230, and so if an NCLT passed an order under section 230, it shall have an power to supervise and implement the scheme. NCLT can give such direction with the scheme. If it's considered necessary, the scheme can be modified. If NCLT thinks that the order passed under Section 230 cannot be implemented by the company with and without modification, and the company is unable to pay the debts, then the NCLT will pass an order for winding up. And such order shall be deemed to be an order under section 270. That means winding up. So simply means कि either NCLT can pass an order. If an NCLT pass the order that the company is going should go for merger and amalgamation, either by way of some modification or without modification, or the company is not implementing that scheme. Say, for example, it was in many more big companies, like it impossible to transfer all the assets and liability in a very short span of time. So, if the company is not following the NCLT orders and the company is not doing all the things that I mentioned in the scheme of amalgamation, and if the company is unable to pay the debts, then NCLT will pass an order for winding up. Now, section 232, merger and amalgamation of companies. So in section 230, we have read that key when application can be made for compromise on arrangement, and it is so that the transfer company, in case of merger amalgamation, the transfer company will transfer all the assets and liability to another company, that is called a transfer company, and can divide into one or more companies. Say for example, a transfer company divide into one company, two company, or three, depends upon the case to case basis. On an application made by the transfer or transferee company, NCLT will either call or either dispense the meeting of the members or creditors. So if there is a meeting requires to be called, we have to follow all the procedures. If we want to dispense the meeting, then we have to get our members and creditors approved by way of 90%. Section 232 says, whenever the tribunal satisfied that the procedure has been followed under section 231 and 232, in case of transfer, all the transfer and whole undertaking of the transfer company will be transferred to the transferee company. The transferee company will allot shares to the shareholder of transfer company, but the transferee company, say for example, in case of a cross shareholding, if the transfer company is holding any shares in transferee company, then that shares will be cancelled. That we call in case of cross shareholding. When transferee company will not issue any shares to the shareholders of transfer company. If an order is passed, that simply means all the properties and the assets and the liability of transfer company shall become the property and assets and liability of the transfer company. The scheme, whenever we are preparing for a scheme, the scheme should indicate that what is the appointed date and the date from which it will be effective, and not subsequent to an appointed date. Every company relation to which order is made, and whenever, say for example, the order has been passed by NCLT, NCLT approves the mergers and amalgamation. So within a 210 days from the end of each financial year, the company is required to file a statement with the ROC that what is the status of mergers and amalgamation. In case, for example, there is a very big steel company or some other company acquires it. So it's very impossible for a company to complete all the procedures within 200 days. So the company is required to file a statement with the ROC that what is the status of this scheme or amalgamation with the ROC within 200 days from the end of each financial year. So it will be filed until the whole process is completed. Now we will discuss that what is the procedure of merger under section 232 subsection 2.
Sir, one small request here.
Yeah.
Since the audiences are all registered valuers and there is a conflict of interest if we do all of this, so can we focus less here and focus, because suppose I am a registered valuer, I cannot do all of this because there is a conflict of interest for me. So if you can also focus on valuation quickly, it's almost
not conflict
8
of interest. So what we can do is that if we are having a no, I'm not getting your question, ma'am. Can you please repeat?
Sir, what I want to understand is, as a registered valuer,
Yeah.
if you can focus more on valuation, because already half an hour is over, because yes, it's very extremely good, extremely interesting session. But then as a valuer, I will not be actually be able to do this. No, so I'm just wondering, can I actually do all this process? As a valuer, it will be conflict of interest, no?
It will be a valuation conflict of interest, definitely. If you can, either you can appear for application, or the other can do a valuation. You have to choose whether you are going for either you can complete the entire assignment or you can do a valuation. Okay, no issue, ma'am. So I will just try. So I'm just keeping all these things, no issue. So the valuer's role here is that the important role of a valuer is to determine the swap ratio. It is the most important role of a valuer. So whenever you are getting any assignment for merger and amalgamation, the most important role is to determine the swap ratio. In case of merger amalgamation, whatever is the value, that means whatever the company will receive the value, the company will have to pay to the shareholders of transfer company, and whatever the left, that will be called a surplus, or you can say the assets. We have to decide whenever we are getting any assignments, so we have to make a valuation accordingly, and we have to check whether the merger amalgamation whether it leads to a value enhancement or value depletion. It totally depends upon the valuation. So whenever we are getting any assignments, first of all we have to make a preliminary steps, a preliminary checkup depends upon the companies that whether our mergers, whenever there is a merger, so we have to give advice to our client whether the merger leads to value enhancement or value depletion. Post merger, post merger, the value and the improvement value and the performance of target company either may increase or either may decrease depending upon the case to case basis. In many cases, you can see that one third or more of the acquiring company destroy their value for shareholders because they transfer all the benefits of acquisition to the selling company shareholder. Say, for example, if the merger was not planned very well, and the merger or amalgamation or any kind of corporate restructuring uh, did without having a proper valuation or without having any proper planning, so we can see that most of the mergers and demergers become unsuccessful because of this reason. The company either may don't plan very well, the company may don't have either a very good amount of surplus, the exchange ratio were not determined properly in advance, or in having a without having any proper valuation or without having any proper planning. So in most of the cases, the value of a transferee company becomes less after when it issues shares to the shareholders of transfer company. So valuation is standard. If whenever we have a scheme or whenever we are planning for merger and amalgamation, so we all the times we heard some of the concept that what is called market value, equitable value, and what is synergetic value. So market value is the estimated amount for which an asset or liability should be exchanged between a willing buyer and a willing share on a valuation date in an arm's length transaction. Equitable value is the estimated price for the transfer of assets or liability between identifiable, knowledgeable, and willing party that reflect the positive interests of those parties. Last but not the least, synergetic value. Synergy in every merger and amalgamation, post merger or at the time of merger, one synergy is created. Synergy value is the result of two or more assets or interests where the combined value is more than the sum of separate value. If the synergies are only available to one specific buyer, then synergetic value will differ from market value. As the synergetic value will reflect particular attributes of an asset that are only a value or to a specific purchaser. Now we will discuss that what is our purpose of valuation and what should be the basis of valuation. So for example, in case of a merger, amalgamation, acquisition, so our basis of value should be fair value, fair valuation, relative valuation, and price calculation. In case of merger, our basis of valuation should be fair valuation. In case of joint venture, our basis of valuation should be as per our JV agreement. In case of FEMA, we have to understand, we have to go through with the international accepted methodology. In case of accounting purpose, our basis of valuation should be value in use or fair value less cost to share. In case of income tax, our basis of valuation should be, and we have to look after section 56 subsection 2 and as per rule 11.1. So whenever we are planning for any merger, we have to check that what is our purpose of valuation, and accordingly we have to choose that what should be our basis of valuation. These are the income valuation approaches and method. In case of income approach, we can use discounted cash flow method. In case of market approach, we can use market price method. CCM method, and comparable transaction multiple method. In case of cost approach, we can use net asset value method, replacement value method, realizable value method. We are not going to discuss all this because we are not going to discuss all these things in detail. Okay. So what is income approach? And when it should be applied, when it should not be applied, and what are the methods in case of income approach? So income group, it's a valuation that can be maintainable or future amount, that is cash flow or income and expenses to a single current or discounted capitalized amount. The fair value measurement determined on the basis of value indicated by current market expectation about the future amount. I'm not going to discuss the meaning, which we can just skip because everyone is a valuer, so everyone know that what is the income approach. So we can discuss that when the income approach should be applied. So where the asset does not have any market comparable or market transaction, where the asset has favor relevant market comparable, or where an asset is an income producing asset for which the future cash flow are available and can be reasonably be projected. So these are the cases where we can use income approach. There are some cases where the income approach should not be applied. The asset has not starting generating income. There is a significant uncertainty on the amount and timing of income. The client does not have access to the information related to the assets being valued. So these are the cases where we have to look whether we can apply income approach or not. In many cases, the valuer get a notice from either by the not by the notice. You can say that objection, or you can get a notice when we apply income approach, but it should not be applied. In case of income approach, there are some method like discounting. We can use either discounted cash flow method, we can use RRF method, we can use MEM method, we can use WVM method, or we can use option pricing model. So we have to check whether in case of income approach, which method should be applied and when it should be applied. In case of market approach, when it should be applied, that where the assets to be valued or a comparable identical assets is traded in the active market. So we have to check whether the assets are traded in the active market or not. We have to check whether there is any orderly or recent transaction that should be valued, or whether recent comparable orderly transaction identical or comparable assets and information for the same is available and reliable. So we have to check whether these conditions are available with the company and whether the assets or the transaction is readily available, then only we can apply this method. There are some cases when these methods should not be applied, like when the assets are fewer identical or comparable assets, the assets to be valued or is market comparable are not traded in the active market, when the sufficient information is not available, when the recent transaction either in the assets or in the market comparable is not available, there are material differences that should be valued, and the market comparable which requires significant adjustment. So these are the cases when these methods should not be applied. In case of market method, we can apply these methods like market price methods. We can use comparable transaction method, and we can use comparable companies method. Next is the cost approach method. When this the cost approach should be applied. So in case assets can be quickly recreated with the substantially the same utility as assets to be valued. In case where the liquidation value is to be determined or the income approach the market cannot be used. So we have to check whether we can, in case we cannot apply the before two method, then only we can use this cost approach method. So there are some cases when this approach should not be applied. If the asset has not yet started generating income, if the asset has the same utility or value can be created either by the regulatory or regulatory transaction and they involve significant time or recreation. If the asset was recently recreated, then in these cases we cannot apply the cost-based approach method. These are the methods under the cost-based approach method, replacement cost method, and the reproduction cost method. So we have to check that whether we can apply these methods or not. Whenever we are planning to do a valuation for mergers and amalgamation, we have to specifically look after section 230 to subsection 232. We have to check whether in case of a listed company, it is required to get the fairness opinion from the merchant banker or independent chartered accountant. There is a SEBI circular call dated 30th November when it was stated the valuation report from independent chartered accountant not required in some cases whenever they know any changing shareholding of the listed company or the resultant company. Say for example, it's in case of a wholly owned subsidiary company. If it's going to be merged, then there is no change in the shareholding. Then, as per the SEBI notification, a valuation report from a merchant banker or chartered accountant is not required. Well, basically, they issue a fairness opinion on the report of a registered valuer. So SEBI has clarified that since there is no change in the shareholding, then in that case, valuation report from chartered accountant is not required in these cases. None of the aforesaid law, neither the company law, neither the income tax law, nor the civil law specifically stated that key which approach should be applied in case of a valuation approaches. But as a valuer, we have to check all these approaches and we have to choose that which method should be applied and in which case it can be applied. Swap ratio. Whenever we are planning for merger and whenever we get any assignment, all the times we heard a word called swap ratio. So in case of a merger, the emphasis is on the arriving the relative value of the shares of the merging company to facilitate the determination of the swap ratio. The purpose in case of merger and amalgamation, the valuer's purpose is not to arrive the absolute values of the shares of the company, but the purpose is to arrive the swap ratio. What is the swap ratio? That we can definitely we will discuss in our next examples, and we can simply understand what is the meaning of swap ratio. So swap, it means a key issue to be addressed the time of fairness to all the shareholder. This is particularly important where the shareholding pattern, the shareholders may vary between the two companies. There are some established legal precedents for merger valuation methodology. The valuer role is to incorporate case-specific factors and to use appropriate methodology so as to determine a fair ratio. Usually, best to give weight. So, say for example, whenever we are applying any approaches, so we have to give a proper weightage depending upon the case to case basis and depending upon depend upon the value to value that what ways they are giving to any approaches. Relative value. So whenever we are planning for any merger, so we determine the exchange ratio. The purpose is to determine the relative ratio by way of determining the share exchange ratio. So relative value simply means the ratio that we can recommend to transfer company and the transfer company, so that on that basis they can issue shares to the shareholder of transferring company. So relative value is usually derived by simple valuation approaches, methodologies and weighting. But there are some exception. Like अगर हम लोग बात करें सिंपल से in case of a operating company, in case of operating company, we can use a DCF and CCM method. Say for example, there is a case when there is a merger of investment holding company into a operating company. So in case of a operating company, we can simply use or we can apply a DCF and CCM method. But for an investment company, we won't be able to apply DCF and CCM method. So we have to follow a NAV method to determine the share exchange ratio. Next, in case of a merger of a unlisted company into a listed company. So in case of a listed company, we can use DCF, we can use CCM, and we can use market price method. But
Mr. Mr. I have one doubt.
Yeah.
In case of an operating company, we can use a DCF method for a swap ratio. For an investment company, you are saying a NAV method. For investment company, what is the logic for NAV method?
Sir, it's an unlisted company. The purpose is for investment. We are talking about an unlisted company. So because it's an investment company, that's why we won't be able to apply DCF and CCM in this case. Because the purpose, yeah.
My doubt is, I agree. Say any corporate actions, any business restructuring for a future growth.
Yeah.
So if investment company is also merging with another operating company, ultimately we need to see what is their potential future potential earning. Based on that, it will arrive. So there, the income approach only will give the true picture, whereas the NAV method is only is a liquidation method. So is it appropriate to use NAV method for investment company valuation?
Sir, as per my opinion, because the company is going to merge with an operating company, Okay, so the existence will be there will be no existence, so we won't be able to apply DCF, and there is no comparable data available in the company. That's why we won't be able to use DCF and CCM method. So we have to either we have to apply the NAV method, or we can check whether we can apply any other method. But as per my view, we cannot apply DCF and CCM in case of investment company. So we can use NAV method to determine the exchange ratio.
Okay, thank you.
See, simply relative value the attempt is to determine the exchange ratio after applying all the valuation approaches, methods, and methodology. What methods and methodology we can apply, it totally depends upon the valuers to valuers. One valuer may say that okay, we can apply this method. One valuer can say that we can apply these methods. But we have to check that okay, what is the rationale for applying all these methods. Taking next example, say for example, there is a merger of unlisted company with a listed company. So for a listed company, we can apply DCF, we can apply CCM, and we can apply market price method. But for an unlisted company, we can apply only DCF and CCM method. So अगर हम वो बात करें, सिंपल सी बात करें कि in normal cases we have to apply all these methods, okay, and we have to check whether valuation report is required or not. There are some cases wherein the valuation report is not required. There are some cases where valuation report is required, and there are some cases wherein joint valuation report is also required. But there are some exception. In these cases we won't be able to apply all these methods, so accordingly we have to choose key in which case we can apply which method, and in which case we cannot apply these methods. So in first two example, the merger of investment holding company into operating company. For operating company, we chooses to apply the DCF and CCM method. For investment company, we chooses to apply NAV method. For merger of unlisted company into listed company, we choosing to apply DCF and CCM and market price method. And for unlisted company, we chooses to apply DCF and CCM method. Say for example, there is a demerger of a listed division into a listed company. For demerger of a listed company into a listed company, we have to apply the SEBI rules accordingly. For listed company, we have discussed that we can apply DCF and CCM and market price method, and we have to also check the SEBI ICDR regulation to determine the exchange ratio. And on the basis of 10 days or 90 days VMAP or VVMAP, we can determine the exchange ratio and recommend to the board of directors of both the companies. Here we are just taking a simple example. So there is an example in which there is a merger of X limited into a Y limited. So in case of a merger, the valuer will have to choose all the approaches. The valuer will have to apply all the approaches. In our case, so for example, the valuer has determined and selected all the approaches. So whenever there is a merger and whenever we are getting any assignment, the valuer will have to look at key what are the approaches that a valuer can apply, and the valuer should give equal weightage to both the companies. And if say for example, if there are more than two companies, three companies, or four companies, the valuer should give equal weightage, because if we will not give the equal weightage, then the price that he will arrive may not be accurate, because the company is going to be merged with another company. So we should give a equal weightage depending upon the case to case basis. So we are just taking an example. In case of a merger, in our example, the company X is going to be merged with company Y limited. In asset approach, the valuer has arrived the value of company X at rupees 50 and give a zero weightage. In case of income approaches, he determined the value as 150 and gave a weightage of 50%. In case of market approaches, he determined the value of 200 and gave a weightage of 50%. For example, for company Y, he determined the asset approach as 100 rupees and gave a weightage of 0%. Because it should be advised, it always advisable to give a equal weightage to both the companies. So in case of transfer company, he has given zero weightage. That's why he has given a same weightage in case of company Y. For income approaches, he determined the value at 310 and gave a 50% weightage. For market approach, he determined the value at 390 and gave a weightage of 50%. Based on all these conditions, he determined the relative value per share of company X as 175, and for company Y, he determined the relative value per share as 350. And accordingly, the exchange ratio are determined, dividing the company of transfer company by the transfer company. So, how the valuer is required to put this in his report? So we are just taking an example that if for every, because our exchange ratio are determined at 0.5, for every share of company X of face value of 100 is 0.5 shares of company Y of face value of 10 should be issued. This is just an hypothetical example. So whatever will be our case, we have to determine, we have to select that what are the method that is required to be applied in this case. The valuer should give a weightage. It depends upon the case to case basis, but so give a equal weightage. After that, he will determine the relative value per share, and after having determining the relative value, he will determine the exchange ratio, and accordingly he will put in his report whatever the number of shares is going to be issued for, say for example, for X, for this amount of shares to be issued for company Y limited. This is in case of a merger. Similarly, say for example, we are taking an example that there is a company called X Limited, there is a company called Y Limited. Company X is going to demerge its undertaking into company Y Limited. Similar things, the valuer has applied all the approaches, has given a weightage, simple equal weightage to the transfer company and the transferring company and the resulting company. Accordingly, he derived a relative value per share as rupees 195, and accordingly he determined the exchange ratio as 0.4 rupees. So in this pattern, the valuer should include in his report that for every one share of company X of face value of 100 each, 0.5 shares of company Y of rupees 10 should be issued. Now, valuation report. Whenever we are preparing for valuation report, in most of the cases, what we see or what our regulators see that the valuer may either skip one or two points, or say, for example, they not include all the content that should be included in the valuation report as per rule 2000, as per register valuer rule 2017 as prescribed in the Companies Act, and the valuation report should also be in consistent with the ICI valuation standards. In most of the cases, you will see that the shareholders get a notice from the company that the company is going for merger and amalgamation, but you won't check that whether the company has provided you the scheme of arrangement or not. In most of the cases, the company don't provide us. The company just simply give a link or simply say that it is available on the website of the company. So, and the valuer, previously the valuers were not providing all the summaries and the working. They just mentioned that what is the exchange ratio. Later, most of the regulators and most of the shareholders were demanding that we want to know that how the exchange ratio are determined. So later on, the regulators came that the valuers should provide a detailed working in his report how the exchange ratio were determined, and if the stocks change, the RBI and the SEBI and the regional data ask we need a separate working from your side how you have determined the exchange ratio, then a summarized working shall be provided by a valuer in his report, or the valuer can annex to his report that these are the summarized working on the basis of which we have determined the exchange ratio. If a valuer is not selecting any method, then the valuer should give a rationale for the same in his report why he has not adopted a particular method and why he adopted a particular method for determination of exchange ratio. In case of in our report, the valuer should give a presentation like this that which approach he has used. Uh, what are the value he had arrived, what are the weightage he has given for both the company. Accordingly, a relative value, how the relative value per share was arrived, how the exchange ratio was arrived, and on the last line he should state that for which shares of company X or company Y, which shares of company Y has been issued. So any question on this, sir? So this was the example of a swap ratio. In case of say for example, in our case, we just taken an example that there was a merger of company X into Y Limited. So we have to apply all these method. We have to determine, we have to give a weightage. Accordingly, we will determine our relative value per share, and relative value per share of transfer company will be divided with the transferring company, and accordingly we can get the share exchange ratio. There are some cases, as per the SEBI circular, there are some cases when a valuation report from a registered valuer is not required. In case there is a merger of wholly owned subsidiary company with a listed parent company, and then there is a demerger of undertaking of wholly owned subsidiary company into listed parent company. This is a SEBI circular that says ki is not required, but as per my view, that ki there should be a report, because we can understand ki what is the purpose of the scheme, or what is the valuer's role, what the valuer is saying that ki whether this scheme should be benefited for the shareholders or not. The valuer is not required to state in his report, but as an advisory, we can definitely state to our client ki whether this is advisable for or not. But in many cases, the mandatory requirement from a registered valuer report is not required, because there is no change in the shareholding company. There is no change in the shareholding company, shareholding pattern post merger or demerger. So we can discuss that there are some cases where the valuation report is not required. Okay, so we are taking an example. In our example, say for example, there is a company called A Limited, who is having a shareholder say A Limited, and company has two divisions, company X and company Y. Company A Limited is planning to demerge this division Y into a new company. New company is not having any existing business. New company is not having any capital structure. So, there are some cases wherein the valuation report is not required, provided if the company is going for demerger into a company who is into a new company. That means the company is not yet incorporated, or either the company will be either the company is not yet incorporated, or the company which is already incorporated, who is having no business, that should have no business, or the existing capital, the capital structure of the existing company will be cancelled post demerger. So in that case only, a valuation report not only from register value, a valuation report is not required. In case there is no change in the shareholding, in case there is the existing capital of the transferee company will be cancelled, and the transferee company will issue same proportion to the shareholder of transfer company A. So in
This
our
is
case, yeah.
always whenever you say demerger,
Hmm.
it's one of the division or one of the vertical will be made as a separate company. The new company will issue the shares to the shareholders of the main parent company. Valuation report is not required, no, in all demerger cases. Is there any situation demerger requires a valuation report?
Yes, sir, we will discuss.
Yeah.
Okay. So in our case, sir, the main condition is that the rule simply says a plain vanilla demerger. So, and we can simply use the term mirror image shareholding. That means post demerger, the shareholding pattern of,
Same. Correct. Parent company
yeah,
remains same.
yeah. So, sir, the shareholding pattern of transfer company and the transfer company will be the same. Say, for example, if 10 persons are holding shareholding in company A Limited, the same person will hold same proportion in transfer company or transferee company. Then only in that case, a valuation report is not required. But if, for example, one shareholder, there is a change in one or two shareholder won't be, they are not willing to approve, or they are not willing to take shares in that company, then the new company will issue shares to the transfer shareholders of transfer company only based on a valuation report. Am I clear, sir?
Yes, yes.
Yeah. So in our case, we just take an example that in A Limited there were two shareholder. The two shareholder meaning to say that one was the holding company, and we just keep one shareholder for the purpose of maintaining two number of shareholders. Post demerger, new company has been formed, and new company has issued shares to the shareholder of company A Limited. So post demerger, A Limited will have its division X and will have a shareholder A, and new company that has just formed will issue shares to the shareholder of company A Limited and will have a division Y. So in this case, since there is no change in the shareholding, existing capital of new company has been cancelled. New company will issue same proportion shareholders to the shareholder transfer company. That's why in this case, a valuation report is not required. Next case, we are taking an example that there is a company called Company A Limited who is having two division X and division Y, and a company is having shareholder A Limited. Company A Limited is planning to demerge this division Y into a B company who is not a new company, is already having a division Y and having a shareholder B Limited. So we can simply check that in our case, a new company was formed who is not having any existing capital, who is not having any existing division. That means it is not having any existing business. But in our second example, the company is not a new company. It is already into existing company. It is already having a division called division Y and already having a new shareholder. In our A Limited, there is a shareholder called A, and in B, the shareholder is B. That means a totally different company, totally different business, totally different shareholders. So in this case, say for example, the company A Limited is planning to demerge its division Y into B Limited. So in post demerger, B Limited will issue shares to the shareholders of A Limited. So post merger, we can see that A Limited will left with its shareholder A, and will left with its division X. But B Limited will have two set of shareholders, shareholder A and shareholder B, and B Limited will have its division Y and division Z, that demerged division. So in this case, a valuation report is required because the company was not a new company. Company's existing share capital is not getting changed. Company existing capital is not getting cancelled, and the company will in turn issue shares to the shareholder of A Limited. Any question on this, sir? Okay.
I think okay.
Thank you, sir. So now we are going to discuss some of the practical aspects in merger and demerger valuation. So we are just taking example that what is appointed date versus valuation date. Appointed date simply means, for example, just taking an example, the example that there is a company A Limited and a company B Limited. Company A Limited where appointed date is, say for example, January 2025, and company B Limited valuation appointed date is April 2025. Okay. Company A Limited has just appointed a valuer and intimated these are unlisted companies. Yeah, taking example that these are unlisted company. So A Limited has just fixed appointed at January and B Limited fixed it at April. So A Limited just appointed an valuer and did all the formalities and provided all the information to the valuer. So accordingly, A Limited has chosen as 1st January as its valuation appointed date and valuation date. In B Limited, say for example, the B Limited had chosen appointed date as the 1st April, and accordingly he just intimated that the company is going for merger or demerger, and in the next board meeting the company will appoint all the valuers, all the lawyers and all the consultant for the merger and amalgamation. So what is the difference here is that in first example the appointed date will be 1st January, and in second example the appointed date will be April. So the valuer should choose the appointed date is not related with the valuation date. The valuation date should only on the day on which the board of director will appoint a valuer to determine the exchange ratio. There may be some cases in which the listed company uh, just give an intimation to the stock exchange that the company is going to merge with another company, and they just give an announcement, and in the next announcement they confirm that the company may be the company is going to merge with that company. Post they only confirm it. So there is no connection between appointed date and a valuation date. Appointed date determined by the board of directors, and the valuation date is just fixed by the board of directors. So appointed date maybe just fixed by the board of director post its second board meeting or in a third meeting, but appointed date can be fixed at the time of scheme at the time of scheme planning. In first example, the appointed date was 1st of January. In second example, the appointed date was April. So there is no connection with the appointed date and the valuation date. Next is the benefit of synergies. The mark a simple say for example in A Limited and in B Limited. A Limited is going to merge with B Limited. So definitely some synergies will be created. Now the question arises whether the valuer should choose these synergies or include this in his report or not. So in my view, the valuer should not include this synergy and do the valuation on a standalone basis, because the synergies will be created only post merger or demerger. So the valuer should choose the valuation and do all the assignment on a standalone basis and not considering the synergies. Synergies will be transferred post demerger or merger. If say for example the valuer will create, we choose or do the valuation based on the synergies, then there may be a cases that the merger or demerger may be cancelled or may not be approved by the regulator. So the valuer report will be not incorrect with those synergies. That's why it's always advisable to do the valuation on a standalone basis without considering any synergy benefits. Now next taking example, there say for example there is a group company merger. So whether can only NAV method be used? This question arises because there is no change in the shareholding. The company is not going to issue any shares. It's not the valuer always try and choose whether there is any possibility of applying any other method. Then only he will issue his report. First of all, he will determine whether there is any possibility or not. Accordingly, he will choose all the evaluation method. So we cannot say that in all the cases only we can apply the NAV method. Next is in case of a market method, the question always comes that for which duration and for which period, say for example, we should take the data. In first example, I was just taking an example. In first case, say for example, the company is a listed company. For company A Limited, the company has fixed called a board meeting and give a direction to the valuer or to the board of directors to appoint the valuers, to appoint the lawyers, and intimated to the stock exchange that the company is going to be merged with this company with effect from this day. In another case, the company has just intimated to the stock exchange that we have not yet get any principal approval, but we are planning for merger. So whenever a company announces any merger, you can see that the share prices may get fluctuated, either may increase, definitely it increase or decrease. So for which duration the valuer should choose the period. So in first case, the valuer should always choose the board meeting date and the previous data, depending upon if it's a listed company. So he will choose the valuation as per the ICDR regulation. And in second case, the valuer should always choose the date on post the confirmation, not only for the first board meeting, because the share price may get fluctuate post the board of director issued a confirmation. Next is, sir, can I just, I was not checking any chat. So do you want to discuss with this me, or we can take in the last at the end?
Sir, can you please repeat this point? Group companies merger can only NAV method be used?
Now, this is a question that in case of a group merger, say for example, if there is only a parent company or a similar company A and company B, both are having a common set of shareholders. So whether can only a single NAV method be used. So it is always advisable to choose all these methods. And we cannot say that since there is a group company merger, there is no change in the shareholding. So accordingly, we can choose only one method. Always a valuer should choose all these methods and try to evaluate the value depending upon the various parameters and give a equal weightage. Not only we will definitely check and say that since there is a group company merger, so I will use only NAV method and I will not use or we have not used any other method. Am I clear, ma'am?
Yes, yes. Thank you so much.
Okay. First, in case of a market price
Uh,
method, yeah.
my submission, sir, in case of a group money, if there is no change in the share capital of the entity, post and this,
Mhm.
then why should we even get into NAV or other method? Can we just do 1:1 or whatever is the shareholding? We just replicate saying the economic rights anyway don't change. So should there be a compulsion to give a certain methodology? We can even give for whatever shareholding we replicate the shareholding, right?
No, without valuation, how will you determine the exchange ratio?
No, why should there necessarily need to be an exchange ratio based on a certain value? Because the shareholding remains the same. In that case, can't you just say for a share entitlement ratio is for every share held, you get a certain share in the other entity?
Yeah, but for that amount, we have to exchange. We have to determine the exchange ratio. Now, how you can say that? Say for example, 1:1. In case of demerger that we were taking, in case of demerger, since like that in this case we were discussing that it's a plain vanilla demerger. So in case of a demerger, if there is a plain demerger, mirror image say holding the company is not yet formed, the company's existing capital will be cancelled, the company is not into any business. In that case only a valuation report is not required, because you can say that the company is not yet formed and it's a plain vanilla demerger. All the shareholder transfer company will be the same in the same proportion of the transferring company. In this case, the valuation report is not required. And the thing you are meant to say that why we need a valuation report, we can just say is
We can
one is
we
to
you
one.
need under the law you still need a valuation, a share entitlement ratio. You cannot do away with the share valuation and entitlement ratio. I'm just saying because it is just the same shareholding. Because
Mhm.
predominantly in all unlisted entities, we see this scenario where they want to just demerge the entity for whatever the reason. Could be family settlement, could be one of the reasons. Multiple cases where they want to split entities. So they undergo the concept of demerger very easily. So when that sort of a scenario happens, then
Mhm.
the share entitlement ratio can be just 1:1 without any requirement for evaluation because the receiving entity, if you would, most probably you won't have a legacy entity there. The receiving entity will most probably be only a new entity, or in some cases, it might be a case of legacy entity. Usually, they don't undergo that. The only reason they go through a demerger is to avoid taxation and the BTA and the consideration flow. That is usually the reason why they pick up a demerger over a business transfer. So, having said that, if the intent is only group restructuring and there is no actual economic benefits that is going to change and it is going to be predominantly the same, then the entitlement can be 1:1 itself without getting into a methodology for valuation.
I am definitely agree with you. In case of a listed company, there is a particular circular that specifically
Correct.
exempted
In
that
listed entities, I agree.
yeah,
Listed, I agree.
ma'am, but regulators sometimes ask that without valuation we want to approve the your scheme. In most of the NCLT or most of the RT, they don't understand this. So the valuers should have, in most of the cases, we have faced this issue, and that's why we just advise a client and we just issue a report. This is on maybe it's a 1:1 issue, but we annex a valuation report based on these parameters so
The
that
annexed evaluation.
yeah. Totally
Correct.
agree with you that there is no sense of having a valuation when there is an entire, say for example, uh, holding subsidiary company or a holding wholly owned subsidiary company. In that case, the share capital may won't be issued. The existing share capital will be cancelled. Okay. So in most of the cases, we did that. Startingly, we were doing this. We were just writing letter. But whenever we have had submitting, say for example, in Delhi, we are submitting paper. The RD may ask for another set of document. In Mumbai, they may ask for another set of document. In Kolkata, they may ask for another set of documents. So it's totally depends upon RD to RD. They generally ask for a valuation report. That's why we issue valuation report stating either it's 1:1 or 1:2, but we generally issue the valuation report.
Correct.
Okay. So we were discussing that key what should be the due rate and what should be the what should be in case of market price method, what should be our duration for which we can select the market data. Some valuers selects as 1 year data, some valuers select 3 months data, and some valuers select 6 month data. Depending upon the value, there is no such rule that you have to select the data from such to such period, and you cannot select the data from this to this period. So there is no clarity as of now. So it depends, totally depends upon the valuer that key for which period they can take a data. But it always advisable whenever the board of directors announces the merger or amalgamation, the valuers should take data before that date only, and not the date before, not the date after the board meeting. In the example we were discussing, say for example, a company announces in January for a for merger and amalgamation. So the valuer, in first case, the valuer has taken data before the January. In second example, the company has just given intimation to the stock exchange that key we are planning for merger with so and so company, but they have not yet disclosed all the details, and suddenly the market price fluctuates. In, say for example, post 15 days or post 1 month later, they have again gave a confirmation that we are planning for merger with this and this company, and we have appointed valuers, lawyers and all. So in second case, definitely the share price was fluctuated. If in second case the valuer selects the data post first board meeting, then the price may not get accurate because the price was already fluctuated. So it's always advisable to choose the data before the board meeting, or you can check whether the price was fluctuated or not. If the price was not fluctuated, so you can select data post second board meeting or till second meeting, or if the price was fluctuated, so it always advisable to choose the data before the first board meeting. Just a second. Okay. So next we were discussing manner of computing market price. So if in case of a listed company, we have to follow the SDR regulation, and based on a VWA map, we can use the market price method depending upon the 10 days trading price, or on a average price method. So just we can understand this by taking a simple example. Either we can use an average method, or we can use a daily method. The turnover and the volume can be multiplied, and dividing upon the number of shares traded, we can determine the market price depending upon the ICDA regulation. And one can do a average on a daily basis how the shares are trading, so they can apply turnover and volume, and they can get a data. It's totally depend on the one valuer to valuer. Either they can take daily basis, or they can take on a average method basis. Date up to which market price needs to be considered, we have already discussed. If there is a more fluctuation, then you should not consider those data post board meeting. If there is no fluctuation, then you can then you can choose your data, or it always advisable to choose the data before the first board meeting, or till the date of first board meeting. Any question on this, sir? Now the question arises, if there is a difference in face value of shares of transfer and transferring company, then how the valuer can determine the exchange ratio? Anyone would like to answer on this? Say for example, there is a company A who is going to merge with company B limited. Company A is having a face value of 10 and company B is having face value of 100. So whether there will be any difference in my method or my methodology, or there will be any impact in my valuation report for this? Okay. So there is no connection with the exchange ratio and the face value of shares. If you can check my example, see. In my case, the X limited face value was rupees 100 and the Y face value was rupees 10. So valuer, there will be no difference in my exchange ratio depending upon the face value of shares. Accordingly, only the number of shares will be changed depending upon the face value, but I have no connection with the face value of shares. Accordingly, I will determine by ratio by having all these methods, and not by seeing the face value of shares of company X or company Y. Single ratio versus range ratio. Uh, Taking an example, say for example, company has appointed two valuers. Mr. A and Mr. B, or in some cases the company appoints a joint valuers. Mr. A has given an exchange ratio of, say for example, 2:1 or 2:1, 3:1, 4:1, whatever, or Mr. B has given a different ratio. So what will happen? The board of director, which ratio the board of director will choose? So it's become very difficult for board of directors to choose a range of ratio or a single ratio. So it always advisable for a valuer to give a single ratio and not a range of ratio, because they may create a problem. If board of directors choose a different ratio or a set of ratio, then the minority shareholder may ask that the company is biased to that company. That's why the board of directors has chosen this ratio. So it always advisable for a valuer just give a single ratio or not a range of ratio. I'm talking about the exchange ratio. Taking an example, like whether there will be any impact of proposed bonus on my ratio. Just take an example. Key, if I just get an assignment for valuation, wherein they at the time of valuation or the day on which I was appointed, there was no proposal for bonus issue of shares of a company. Later on, at the time of issuing my report, the other information came from the board of directors that the company has issued a, or the company is planning for bonus issue subject to approval of the shareholder or subject to approval of the regulatory authority. In that case, whether I should select those bonus shares or not. Anyone would like to answer? Okay. See, we will check all the facts and data on the day on which we are getting appointed. If in a first board meeting there were no proposal of bonus share and I was appointed and I did all the evaluation, later I came to know that board of directors is planning for any bonus issue, then definitely there will be a change in my valuation depending upon the factors. So the and the valuer may won't be able to know. In most of the cases, we want to be able to know that whether the company is planning for any bonus or not, and the bonus definitely will be issued at the time of AGM or at the time of EGM. So there will be no impact on my report because I have chosen my valuation date before the issue of bonus share, and the board of director has not intimated to me. In most of the cases, or in some cases, say for example the period was less, so the board of director may request a valuer to add an addendum to his report by considering the issue of bonus share. So the valuer either may consider or either may not consider, depend upon the valuer to valuer. But in my view, it should not be considered because at the time of appointed or on the valuation date, the proposal for bonus issue was not considered, and it was considered and was approved post the valuation date. Now, taking an example that there is a demerger of undertaking of demerged company into a new company, whether new company is not yet incorporated. These are very difficult cases. Like say for example, the company A is going to demerge with company B Limited, but that company B Limited is not yet incorporated. So it very difficult for a valuer that the company which is not yet incorporated, how we can just without having a company, how we can determine the value in case of a demerger entitlement ratio. So these are very difficult situation for a valuer that the company which is not yet incorporated, how we are going to value a company. So take an example that what the valuer will do is that the valuer will discuss this with the board of directors that which company you are planning to incorporate, at which capital, authorized capital, paid up capital, who will be the shareholders. All these things will eventually will be incorporated before incorporation of a company, and the valuer should include all these things in his MRL. The valuer will take an MRL from the company, and accordingly the valuer will determine the entitlement ratio for a company which is not yet incorporated. These are the very difficulty for a valuer that he is doing a valuation for a company which is not yet incorporated, is not having any capital structure, is not having any company detail, but it happens like in most of the cases the company may demerge its undertaking into a new company which is not yet incorporated. So the valuers will discuss with the board of directors that what will be the structure of the company, who will be the directors, who will be the shareholders, and according in the same proportion, whatever will be stated by the board of directors, the company will be incorporated in the same proportion. Accordingly the valuer will determine the entitlement ratio. Taking next, in most cases, you can say that the company issue cash or equity shares or the preference share or the redeemable shares. So if it's a cash transaction, it's simply any method we can use. If instead, for example, the company is planning to issue a preference share or redeemable preference share or any other mode, so the valuer always try to choose that key how the company is going to be affected by issue of those shares. Accordingly, in case if it's a preference shares, accordingly the valuer will determine the shares basis on a preference share basis. If it's a company is going to issue debenture or the ESOP or any other modes of shares, so the valuer will choose those method, and valuer will take into consideration the method or the modes the company is going to be issued. Say, a company is going for a preference share, the valuer will determine the exchange ratio by dividing the equity and preference share. If the company is going for another mode, the valuer will choose. So, valuer we have to discuss with the management that in which mode and in which method we are going to issue shares to the transfer or transferring company. Accordingly, only the valuer can determine. Without having a proper information or without having any proper discussion and without having a proper MRL, the valuer should not issue any report. But most of the cases, what we do is that we don't take any MRL. We don't keep all the documents from the client's perspective. So it always advisable for a valuer to maintain all the documents, not only in a soft copy, if it's possible, then in a hard copy as well. Keep the mail trail that key in which discussion you will discuss. Include all those points in in your report, whatever may be the disclaimer, whatever may be the extra points, you should always include. Always try to disclose all the discussion that you can happen in your mail trail or you can in your documents. Always try to protect yourself. Always try to keep and maintain all the documents for your future perspective, because there may be a situation that the regulatory authorities may come and may ask for a different set of document. So it always advisable and always suggestion for our valuers to keep all the documents in ready and discuss with the management that what is their objective for mergers. Without having any objective and without having any planning, we won't be able to issue a valuation report, because the purpose of a merger and amalgamation is totally depend upon the valuation report. Whatever will be the value, the board of directors will determine whether it's they beneficial for or whether it's beneficial for them or not. Then only they will choose or they will go for merger and amalgamation or demerger, whatever may be. We should always refer the scheme of arrangement. We should always keep a copy of scheme. In most of the cases, the board of directors don't provide us the scheme of arrangement. So there may be an issue that in one of the cases, in a don't remember the name, in one of the cases it has happened that in valuation report, say for example, it was written by the valuer that A company is going to be merged with B company and C company or whatever. But when the scheme was filed, the scenario was changed. The valuer, either it was the mistake of board of directors or it was the mistake of the valuer that the board of directors did not intimate or whatever be the situation. So it's always advisable to refer the scheme of arrangement, because if you will have a scheme of arrangement, then only you can get an idea that what is the rationale of the scheme. Accordingly, you can choose the valuation method. Accordingly, you can advise to the board of directors that whatever what is the basis on which the scheme is going to be affected to the shareholders and the board of directors. So we can now we are going to discuss that there are some cases wherein first there is a merger, then there is a demerger, and again there is a merger or there is a demerger, and there is, say for example, there is a capital reduction, there is a preferential allotment prior to or post merger. So we are taking an example. Just say that, say for example, in case of there is a company called A Limited who is having a shareholder as A Limited, okay, and there is another company called B Limited who is having a shareholder of B Limited, okay. Before merger, the company is planning to issue a shares on a preferential basis to the shareholder of promoters of A and B Limited. I'm just drawing an example that A Limited is having a shareholder, B Limited is having a set of B is having a shareholder of B Limited. Company B Limited is planning to issue shares to the promoters of B Limited and A Limited. Later on, B Limited and A Limited merge with B Limited. So post merger, what will be the shareholding structure of B Limited? B Limited will have three set of shareholders. B Limited will have a promoters company of A Limited and B Limited. B Limited will have a shareholder of A Limited and B will have its own shareholder. So how the valuer will consider all these things in its report, because there was a preferential allotment before merger. So accordingly, the valuer should choose and select the methods, and valuer should also consider the preferential allotment in case of determination of share exchange ratio. Not only he will consider only equity shares, but he should also consider the preferential allotment at the time of determination of his exchange ratio. Taking another example, say for example, there is another example in which first there is a merger and then there is a demerger. So we are taking an example. Say for example, there is a company called Q Limited who is having a shareholder of P Limited and having a shareholder of Q Limited. Now, the merger of division of Q Limited is planning to be happen in future with a R Limited, and R Limited existing capital and the existing division will be cancelled. There is no division. The existing capital structure of R Limited will be cancelled and Q Limited demerged with R Limited. So first in this case we are discussing that first there was a merger, P Limited and Q Limited. P Limited merged with Q Limited. So Q Limited issued shares to the shareholder of P Limited. Then Q Limited demerged its division, is one of the division with R Limited, and accordingly R Limited's share capital was cancelled. So what will be the scenario? The scenario will be that key Q Limited resulting shareholder will be P Limited and shareholder of Q Limited, but R Limited will have only two shareholders. R Limited will have the shareholder of P Limited and R Limited will have the shareholder of Q Limited. So it's very a difficult situation for valuer, because he first there is a merger, then there is a demerger. So the valuer will determine the entitlement ratio. Firstly, depending on the basis of merger, he will consider all those facts, he will consider all the data, and accordingly he will determine the share exchange ratio depending upon the merger only. And then there is a demerger. Post merger, there is a planning for a demerger. So the valuer should have also have to consider that what is the planning for demerger. So accordingly, the valuer will determine the exchange ratio based on merger. Then he will again determine the exchange ratio basis on the demerger. After having a both merging both the things and planning all the things and keeping in mind both the things, he will issue a final report, that is called a final report post having consideration with merger and demerger. So it's a very difficult situation for a valuers, that he just giving an idea, he just assuming that the thing is going to be happen, and accordingly he is doing valuation. So it's always advisable with the board, advisable to the valuer, that he should always discuss and take proper document from the board of directors, do all the research, do all the analysis, do all the things, and then only issue a valuation report, because the valuation report may be challenged by any other shareholder or may be challenged by any other person on a case to case basis. So it's always advisable to always choose the things and check the plannings, that how the valuation is going to be affected, how we can change our valuation, whether the valuation report is accurate or not. Taking an again example, next example, the example they we are taking in first example, we have taken in first case we have taken example that key first there is a company, they have issued a preferential allotment, and then there was a merger. In second case, firstly there was a merger into a new company whose existing capital has been cancelled, and then there was a demerger. In next case, say for example, we are discussing first there is a demerger and then again there is a merger. So I'm just taking an example. Say for example, there is a company called R Limited. Okay. R Limited is having a shares of P Limited, shareholder as P Limited. R Limited is planning to demerge its undertaking into P Limited. So P Limited existing capital may be existing share capital will be cancelled and P Limited will issue shares to the shareholder of R Limited. Then after this demerger, the company is merged with a Q Limited, but it's another company. So Q Limited will issue shares to the shareholder of R Limited. Post demerger, the Q Limited will have a shareholder as P Limited and as Q Limited. Post demerger, if we will see that what is the shareholding structure of R Limited. So R Limited will have the shareholder as P Limited and Q Limited, who is demerged with R Limited, will have a shareholder as P Limited and Q Limited. So in this case, we have discussed that first there was a demerger and then there was a merger. So valuer first have to consider what is the exchange ratio in case of first of all if there is a demerger and in after merger. So accordingly, valuer will have to choose and valuer have to determine the exchange ratio depending upon both the cases, and accordingly post this discussion the valuer will issue a valuation report. Any question or any issue on the slides that we have discussed? Because I have skipped most of the things. So with this, I would like to conclude my session. If you have any question, any side, so we can discuss on these slides.
I just wanted to ask one thing. In case of unlisted company, can the valuation date be post the board meeting date?
Ma'am, valuation date post board meeting. See, most of the cases we take the as the first board meeting date because you will get all the financial details on that date only as signed by the board of directors. If the board of directors don't provide you on a date on all the documents on that date and they are planning to give a document on, say for example, if the board of directors appointed you in a June, so you are mean to say that the appointed date can, well, valuation date can be July, right?
Correct.
Right. So in this case, if the board of directors provide you a detailed financials or all the supporting documents on the as on the July, so accordingly you can have a valuation date as July only.
Okay.
Valuation date totally depends upon the document that you will get. If you will get a document signed as per the June, so accordingly the valuation date will be that. And if they provide you a document on the basis of July, the valuation will okay. Just giving in case we just taking example that key the valuation or the parameters should not be older than 6 months, because if you do a valuation you will submit a report to the NCLT or RD, and if it's the valuation date is older than 6 months, then they may ask for a revised valuation, depends upon the financial parameter that will be provided by the board of directors. So it's always advisable.
Older than 6 months from which date? Like from the date of
It
filing of
should not
petition?
be, no. It should not be, say for example, if you are selecting valuation data June, okay, so it should be completed within November or
This.
December. Matlab the valuation date should not, matlab the documents and the assignments should not be older than 6 months. You have to submit all the documents before the NCLT within 6 months from the date of valuation date.
Okay. Filing of petition, you're saying.
Filing of
Application.
petition. Yeah, application. Because key post 6 month the malab, post 6 month the data may be changed. That's why it's advisable to keep a 6 month gap so that key accordingly you can determine the exchange ratio.
No,
Okay.
sir, do you mean to say that the valuation report date and the valuation date should not be more than 6 months apart from each other?
Sir, see, valuation, they concept called valuation date. So definitely if you have a valuation, I have not seen any cases key you may take a 6 month to issue your valuation report. So if you get a valuation date as on June, so you can take a July, August or September maximum.
No, not like that.
Okay.
I'm not taking 6 months, but the management approaches me, say, at the end of July, that they want the valuation report, and I issue them the valuation report dated, say, 30th of September. from 31st of March,
Hmm.
then it should be 6 months, no, not more than that.
Valuation date should not be 6 months, sir. Not the report.
No, no, they approach me in the month of August, say that they want the valuation report and they don't give me the data in time. So by the time I complete my valuation, give them a report, it is 30th September. But they
Right.
want me to give the valuation date as 31st of March.
Got it. So, sir, for which purpose you are doing valuation?
Say for issue of fresh shares.
Okay. So, sir, the thing is that na ki the main criteria is this, that ki the 6 month is for a listed company, that it always advisable to keep a 6 month from valuation date. In mergers and amalgamation, the NCLT don't approve the schemes or don't approve the valuation having a 6 month. In another cases, say for example transfer or issue of shares, we generally take a audited balance sheet. So if for example we are doing valuation in the month of January 2025, and the January 2025, so definitely the audited balance sheet will be get for a March 2024. That will
Yeah.
be the valuation date. It's already 6 months later. So in case of a income tax, it always for 11 UA, it always advisable to take a audited balance. If the management want to get the valuation basis on that, so you can issue on that basis. But if you can get a provisional or any other balance sheet on a current date basis, and if there is no change, that there will be no change in the audited figures and the unaudited figure, then only you can do a valuation, and you should do valuation on the basis of provisional.
Okay, and this is applicable only for the listed companies.
In case of merger demerger, basically we follow this practice that we don't take the data post 6 months, because the NCLT rejects it or give a question remarks on that. Hello.
So
Yeah,
there is no rule as such. It is only a practice that is being followed
yes,
because
practice.
they
The data
disapprove
and
the
the
valuation.
the data and the report may get changed because of the post dated figures. That's why it's because, say for example, post 6 month the valuation was 200 rupees,
Yeah.
and in between some transaction happened. For that the price should be 800 rupees. So if you will issue or you transfer, so definitely it will be loss for the shareholder. That's why it's always advisable to keep a 6 month buffering period. That's why we follow this practice, sir.
That's right. Okay.
So two or more thing is that ki what we face in merger and amalgamation, because in the first things the reason for discussing the issue was not that ki we cannot do. The thing was that ki we should at least have an idea that ki what is the process of merger, because if we have an idea, so accordingly we can do the assignment properly. Because you don't have an idea, there may be a situation like selecting the appointed date, selecting the valuation date, what documents we should check, what documents we should have. That's why my purpose was to keeping the previous slides was that we should at least have an idea that if we are doing a valuation, so we must have an idea what are the process and what's the documents we should take from the client for doing the valuation. Any other questions, sir?
Sir, am I audible?
Yeah.
So my question is that, somewhere you had actually told in the slide that, cost basis should not be used, NAV basis should not be used where operations have not been commenced. So can you just go back to that?
In this slide, ma'am?
Not this slide actually. There was another slide which actually spoke about cost approach, when what should not be used, when what should be used.
Okay. Yeah.
Yeah, so when you have said that the asset has not yet started generating income, either directly or indirectly, a cost approach should not be used. So, what
Right.
approach should be used in these cases? I have newly incorporated a setup,
For
and I
newly
am just
incorporated, ma'am, it's always advisable to use NAV method
okay. So,
because the
what is the
entity.
difference between NAV method and cost basis?
See, if for a newly incorporated company, the company, if you don't have any projection, so you won't be able to use income approach because you don't have any projection because the company has just incorporated. Okay, you don't have the market transaction or the market comparable, so you won't be able to use market approach. So the only option you have left with the NAV method under the cost approach.
So there can be future
Yeah,
projections no,
that is okay, sir.
available.
Future projections are okay. So, we mean to say, if the company had just, say for example, the company had just yet incorporated and the company not having any business. So, without having any business, you won't be able to prepare the projection now. Until there's some data, there's some business started, the company is planning for some business. Then only you can prepare a projection and then only you can select a DCF method. Because the company has just, say for example, company has incorporated today only. You can make projection, that is okay.
No, but the company has been formed with certain business purpose in mind, no? So based
Yeah,
on
that's
that,
why
they can always prepare the projections.
that is okay, sir. I'm always saying if you can prepare a patient, if you have a business idea that you can think you can achieve in future, then only you can prepare. You should select the DCF method. If there is just a company
Obviously.
has incorporated just without having any
Any
background,
company is incorporated with a purpose only. Without purpose, no company is incorporated, I think.
Exactly,
so
Every
exactly.
time there is a startup or something, they always have something in mind. Then only they incorporate the company. First come the business idea, then come the incorporation of company.
definitely correct, ma'am. But say for example, that if you have just incorporated a company today, definitely there is an idea. But say for
Yes.
example, you have taken a hypothetical figure that we will achieve a turnover of 1,000 crores in 1 year without having any background. So in that case, how
We
will
can
you?
validate the projection.
Yeah, that if
We
you
can
can
anytime
prepare,
validate the projection.
if you can prepare if you can prepare the projection and the projection acceptable to the valuer, then they can definitely use the DCF method. There is no such bar you cannot use the DCF method.
So I think what my understanding is, it all has to depend on the circumstances of each case.
Right.
So if the
Right.
management has no intention to kind of continue the business with for the purpose for which it was formed, and it wants to dispose of the company immediately, and like they say, it is like whatever is the best value that it can achieve. So one of the approaches can also be the NAV basis under the cost approach.
Right, ma'am. See,
And what NAV could be, what assets could be there? If the company just formed, there is a capital infused by the promoters and there is a cash lying in the bank to the extent of 1 lakh rupees. So where is what are the net assets of the company? 1 lakh
The
rupees.
bank
Based
itself,
on
the
that, how
bank
can we
balance
arrive at a
itself is
value?
the bank balance itself
only
is the net asset. So if they
the
are able to
Yeah, but
recover
only
any
on the
amount,
basis of bank balance of 1 lakh rupee,
the
which is
value
minimum
will be less.
required.
So the value, definitely the value will be the
The
face
value
value.
will be lower than the face
Yeah.
value, then we have to give as per the face value only.
Yeah.
Yes. It happens in most of the newly incorporated company when we don't give us the
Definitely the in case of
projections.
newly
So why a
incorporated,
valuation report is required in that case? That's what I'm saying.
it's mandated by the
Private
law.
placement actually.
Yeah. Say
Yeah.
for example, if you are doing anything that is mandated by the law, in which case the mandatory requirement of for a valuation report. In that case, either it's a newly incorporated company or a old company, you have to get a valuation report. For example, if you are just issuing shares to your existing shareholder by way of a right issue, then in that case there is an exemption. But if you can want to issue you can get the valuation report as per the income tax purpose, so you can get it as per the income tax purpose. But for companies act there is a relaxation. That's why there is a relaxation. That's if you are issuing shares to your existing shareholder, in that case the valuation report is not required.
Can we use a combination of two methods? Say, for example, income method and this NAV
it's
method. So
it's
income
always
could be
advisable, sir,
DCF
if
based.
you can, yeah, if you can choose one or two or three method, and you can give a rational scheme that key on what basis you have chosen this method, and you have put the weightage, and accordingly if you can make a combination of all the methods, then all is always advisable. And if you are not following any method, so there must be a reason, and you should include in your report what are the reason on which basis we have not selected this method.
Yeah, that I understand. Where I was coming from is that being a newly incorporated company, since as I think we are discussing that the balance sheet has only the bank balance. So
Yeah.
obviously the NAV method is one approach. Second is if the projections are available. So maybe a valuer can use a combination of two methods, give a proper weightage to it, and then provide a value. I think that also approach can be taken. Am I right?
Sir, if you will choose a DCF method, then definitely the value will be higher depending upon your projection. And if you
Mm-hmm.
choose a NAV method, the value definitely either be the less than the face value. Then in that case, how will you choose the method? Either you have to follow one method, or if you will give a weightage, then you can give a weightage. Then you can give an average of both the method, and you can determine a figure.
Correct. That is exactly what I'm saying. Understood. No problem. Thank you.
No, what we learned is that if we have to value the company as a going concern, then DCF is the most appropriate method. So for that, we need to have the projections from the management if they want to continue the company as a going concern and add more shareholders to their fold.
Right, sir. And sir, the projection should be viable. It's not like that you just incorporated a company and you have.
Sometimes the company doesn't give the projection. They ask us only कि you will make the projection. How can we make about their company? That is the question.
No,
You can
for that
prepare,
there are
but
ways and means. You can get it made from some
prepare.
friend of yours.
Yeah. What we do that ki we get it prepared. Either you can prepare or you can get it prepared from any other person. But that should be signed and vetted and confirmed by the management. It's not like that ki you have just prepared from yourself and the management has not agreed.
Yes.
It should be agreed and should be accepted by the board.
That should they should give us the at least the revenue growth. They should give us the capex. They should give us the working capital. Otherwise, it's just numbers we are putting in the projection without valid assumptions.
So whatever the data you need, you have to ask from the management. Without having data, how will you prepare the projection?
Yes. Practically, it happens sometimes they don't give that. Just you prepare something. Their statement is like that. It's very odd.
Yeah, you prepare, but you have to get the data. Na? Without having data, how will you
Yes,
determine?
yes, it is. Without data, it is not possible.
So you can prepare, give it back to them and say that, okay, you now give it back to me through email or through some mode.
Whenever we prepare any projection from
you.
our side, we just mail to the client and give a confirmation. We take a signed copy from both the directors or the single directors. Then only we prepare the DCF method, and then only we prepare valuation report based on DCF.
I think it's actually an opportunity if you are able to make the projections. So there are two separate opportunities. I would treat that
They should pay us accordingly also. But in many cases, they are and we are startup. We can't pay you like this. So it is very difficult to do in that kind of circumstances.
In that case, you should not accept the assignment if it's not remunerative.
You are in Kolkata. You know how clients are here.
Yeah, I know, but that's the thing.
Yes. Any other question from anyone?
So for 11 UA, what I had been following, in case there is need and necessity of any such valuation for transfer purposes, I would value based on last audited numbers, and to that based on the past year projections or averaging, and based on the current year estimates given now, I work out some per share value add, say 10 rupees. Last year it was all in all 40 rupees add was there, and now I am being asked to value something in July based on this 31st of March 20 say 24 number. So what I would do is I would make a proportionate addition to that and write therein, specify therein based on the past year data and current year estimates. So this would have been the accretion or value add to the 31st of March number, and so that it's not a kind of say loss to the exchequer. I write specifically there and then issue this report. Is this a correct approach?
Sir, you are saying for 11 UA, you have done the valuation based on projection.
Last audited date. Yes. No, last audited date number.
Okay. So as per last auditor, you are saying the value was something different, and
yes, it was 200 rupee. So
okay.
based on last year profit per share. So 10-year accretion has been already been there. I am issuing some report in July. So what I would do is, in order not to create any loss to the exchequer, I am adding proportionate 3 months value to this 200 rupee arrived at based on 31st of March 24 number, and said that was 200, and add proportionate accretion 10 rupees. So I value specify 200, why I am opting for 210 rupees.
Okay. So you
But
mean to
Rajiv
say
sir,
you got
sir, my submission is income tax. If this is for income tax 11 UA, they will always go by the financial year or the assessment year, no?
yeah, I was just coming on that only.
Yeah.
So
So
if we are doing
31st
11
March,
UA, yeah. So
yeah,
at that time, either you will choose. See, if we are doing, for example, the March 2024 data was available, and in April, May, June. So you have added 3 months. So like only you will take a data for 3 months only. In 3 month data, the March they will include the data on the March. So you can take a valuation data 31st July,
30th June.
30th June, right?
What happens is 30th June provisional data they are not providing. So
See, as a valuer,
I write
if the
hearing.
company is
I
not providing you any data, then how will you able to provide the figures, and how will you able to determine their PL and the balance sheet? As a valuer, you won't be able to prepare and it is not your duty to prepare the balance sheet and PL for 3 months.
Correct.
That is what my submission to you was. So what I do is I write specifically based on the last audited number of 31st March 24, this works out to 200 rupees. And since the transfer is being contemplated in the month of the April, in the month of July, when I'm making this report, to take care of the additional accretion and not a loss to the exchequer, since no provisional data for as on 30th of June has been provided to me, I had opted for proportionate value accretion for this 3 months lapse in between.
Sir, if the data is not provided to you, then how will you add the value to
Yes,
your
we
share?
can't add. It is also
That
my
means you
How?
opinion.
you are deriving
We can't
something
just
of your
add on our
own
own.
and adding to your report. That's not actually permissible.
You should take all the data and the valuation date signed by the management. If the management provides you data on 30th June, then only you should consider 30th June as your valuation date and consider all the data. If the management is not providing you in the for the data for the period of 3 months, then you should consider the data till 31st March only.
Okay.
It's not your duty to go and visit the company and check the
Yeah.
documents and add the value to the companies just because the management is not providing you the data. How will you have the data? Say, for example, you have taken a figure of 200, well, say, for example, 5 lakhs as the monthly turnover, but turnover may either be less or may higher than the actuals. So it's not possible for you to add the data for 3 months period. So it's always advised to check the documents and get the documents signed by the management on the valuation date only. So whatever data they will provide you on valuation day, do a valuation on that basis only, without giving any external efforts
Yeah.
for preparing the data for 3 months or 4 months.
And as a valuer, why we should put ourselves to risk of this kind?
Definitely, the management is not willing to sign. So how will you get the data?
Thank you. Thank you. That was helpful.
There is any other question? So thank you all for joining, and thank you,
Thank you
Manohar,
very much,
for
ma'am.
this very interactive session and enlightening us more about this corporate restructuring valuation. Thank you, Manohar, on behalf of Bangalore Valuer Association. Thank you, participants, also for your interactive session with us. Thank you.
Thank you so much.
Thank you. Thank you. This is our short of honorarium for you. We will courier it to you. It will be delivered to you.
Thank you so much.
Thank you, Manohar, for the joining.
What
And
about
I
participants?
think, yes.
Anything for the participants?
What all the participants?
Participants will get their CP hours if they have registered for the
Yeah.
same. Participants are always welcome, as they, for the participants only we can hold this kind of seminar. We are always grateful to participants. Thank you for joining, sir.
Thank you so
Thank
much,
you
ma'am.
very
Thank you
much.
for inviting me.
Thank you. Thank you. Thank you.
Thank you all.
Thank you. We are closing this meeting. Yeah. Thank you.